even though rates might be low at a particular point in time, there is this vulnerability when you get your debt levels very high relative to GDP, that if interest rates spike, you can no longer finance the debt.
It seems like a long time ago when interest rates were so low that governments thought nothing of borrowing. In fact, they were often encouraged to borrow. But lots has happened since then. So in hindsight, was it a good idea?
They built up large debt stocks, and then, that had been at 1% interest or even lower. Now it was 4, 5, 6 times of what they had been paying. And then it becomes a big issue. I'm Mark Aguiar. I'm a professor of economics at Princeton University, and I focus primarily on international economics.
Aguiar is also the director of Princeton's economics section, and his recent article titled The Poison Chalice of Debt is published in the June issue of Finance and Development magazine. So, just to start off here, debt markets are something that you've been studying and have a deep understanding of how they work, but I don't think that's necessarily the case for all of our listeners. So can we start maybe with a bit of a refresher on what sovereign debt markets are and why governments are drawn to them?
Yeah, so there are a number of reasons why governments tap into sovereign debt markets. My research focuses primarily on emerging markets. And there they want to tap in ostensibly to a global pool of savings that they can use either to fund investment projects or to smooth fluctuations in government revenues or income. There's a parallel market for advanced economies. Think of the United States or Japan. Those markets tend to be much different than emerging markets. There isn't the same type of volatility or default that we see in advanced economies relative to emerging markets. So my focus is primarily on markets in which governments face a premium to borrow because of the risk of default. And now that includes some of the European economies as well, after the Greek and the Euro debt crisis in the 2010s, that they've also had to pay a premium and are subject to some of the similar volatilities that we've seen in Latin America or other emerging markets.
And are sovereign debt markets essentially accessible for most emerging market economies?
So for kind of the middle income emerging markets, they are very accessible. For the poorest nations, it's a combination of private sovereign debt markets and bilateral loans or development assistance loans, and those behave differently. So primarily my interest is in the interaction between sovereigns and private lenders, typically through the bond markets, when there's this inherent risk of default on the government side.
I see. So the thesis of your work, at least with regards to what you write in this article that you wrote for Finance and Development, is that debt is not all that it's been propped up to be. And you talk about what you describe as the neoclassical paradigm. What is the false assumption with regard to sovereign debt that you speak of?
Yeah, so the neoclassical paradigm, as I termed it, I think is a paradigm that believes in what I was just referring to before, that sovereign debt markets are useful for countries to tap into this global pool of savings. So first, let me just talk about the investment side. In a closed economy, all investment has to be undertaken through private savings, through private citizens delaying consumption and investing in equipment and plants and those kinds of things, whether it's through the government, through a tax and public investment, or through private investment. But that constraint is very tight for an economy that's growing and the citizens aren't enjoying the high levels of consumption that they will in the future. There's an argument in favor of a government going into global savings markets, bond markets, and borrowing from savers in Europe and the US and Japan, et cetera, to fund these projects rather than delaying consumption of its own private citizens. So that's one leg of this neoclassical paradigm. The second leg is that these economies are subject to a lot of fluctuations, and governments may want to use foreign bond markets to smooth tax revenues. So there might be a boom or a bust cycle going on. And then rather than slashing government expenditures in the bust and spending more in the boom, which is kind of counter to the typical stabilization policies that we think of, they would rather use the foreign bond markets to smooth through these fluctuations and provide a more stable level of public services. So these are the two pillars that were kind of inherent in this promise of sovereign debt markets that really began to develop in the 70s, 80s, and 90s, where governments really tapped into global savings markets. And that's kind of what I would say is the neoclassical paradigm, meaning that that's the standard two arguments you hear in favor of sovereign borrowing. And that's what I've become skeptical of in my own research.
And so I guess the question is, how did this neoclassical paradigm come to be? I mean, given, as you say, the data seems to prove it wrong.
Well, because in the 70s and 80s, we didn't have this data. Particularly in the 70s, there was a lot of borrowing going on from very low levels of debt. And there was this sense that governments really didn't go bankrupt and that these were good bets. And there was a large pool of savings being recycled into these economies. Then there was a Latin American debt crisis of the 80s, but that was kind of thought of as a particularly special event, perhaps. And that was solved by the Brady Plan, which kind of ushered into this wave of bond market borrowing by sovereign countries and emerging markets in the 90s and 2000s. And so this kind of, like any idea, it's hard to lose. It's so kind of compelling, and both the lenders and the government borrowers and even some of the third-party institutions like the IMF have a stake in this paradigm. And there is some, compelling theory behind it. It just hasn't worked out that well in practice. And so, the points that I've stressed in my own research is that on both of these dimensions, we don't see it working as it should. There's not this growth as an outcome of borrowing, not increased. You don't see the increased investment. These countries become indebted and their growth stagnates. So we don't see it on that element. And on the other side, the countries that are aggressively tapping into bond markets tend to have more volatility in their economies, more volatility in government expenditure. So it's not smoothing or reducing volatility. It's if anything, seems to be amplifying volatility.
And so, I mean, reading through your piece, what struck me is how, when it comes to borrowing, a lot of common sense is lost to what might be thought of as easy money. And I like how you describe borrowing at the government level as a way to kind of de-link spending from their revenues, which seems a bad idea in economic terms, no?
Well, at high frequencies, there is some sense, and I'll give you a recent example where this paradigm worked best was the pandemic. So countries shut down, but citizens still needed public services, and there was a pool of savings from the richer countries that was being recycled into emerging markets to help smooth that. And then the idea would be, when we came out of the pandemic, growth would return and they could pay back this debt. Right. So that's kind of the best case scenario for this argument. Leaving the pandemic aside, which was a very special thing, the business cycles that emerging market experiences are not like the pandemic, sharp temporary downturns. They're very long lasting and persistent downturns. And if you borrow going into these things, there really isn't a lot of revenue and output at the other side of the recession that's easily available to repay this debt. So countries often borrow in these bad times and then find it very difficult to repay, and then they default, and the default has its own disruptions of the economy and prolong these recessions. So what we kind of saw in the 80s in Latin America tends to recur after defaults or after high debt periods. So that's kind of the bad case scenario of trying to borrow into periods of low economic activity.
Right. So part of the problem, I guess, with these debt markets is the risk that's associated with them, and you talk of how those risks affect borrowing patterns through booms and busts. And you just described a kind of a special case there in the pandemic. Is there a way, do you think, to mitigate some of that risk to make sovereign debt deliver on its promise in terms of improving welfare?
Yes, I think perhaps the safer way, or one that avoids some of these issues, is rather than borrow, is to build up what we call a buffer stock of reserves, of liquid, safe assets. For example, buying bonds issued by relatively safe economies like the US or Germany or Japan, depending on how much currency risk these countries want to take on. And then drawing down these reserves in crisis times. What that takes is political institutions that allow a country to save, right? That is what's been in scarce supply in many of these economies, is once these reserves start getting built up, there's a temptation to spend them, even in good times. And so it requires kind of a political economy environment in which successive governments understand that if they put in the savings, they will know their successors will use them responsibly. Because if you know your successor government is going to spend them on their pet projects, there's no incentive to do the saving in the first place, and you might as well spend it on your pet projects. So that's kind of this bad political equilibrium that many countries fall into.
Yeah.
If they could avoid that, then there is a path in which you build up a buffer stock of savings. And you see this early on in Asian economies after the Asian crisis in the late 90s, that they did start building up big stocks of reserves and not relying on sovereign debt markets. And it has served them well in terms of the subsequent growth.
Yeah, and that's the other, another point that you make is how it's the citizens that ultimately end up paying the price of borrowing. Like as you said, governments tend to, they come and go, and the citizens remain and are left paying the bill. How do political cycles play into this debt story?
Yeah, so it's important to understand that the politicians are the ones issuing the debt, but it's the citizens who ultimately have to pay it,
right?
Or even more severely, bear the consequences of default. So default is associated with big disruptions in the financial markets, the trade markets, export markets, and the domestic economy. And we're getting a sense of this, that these costs are not equally borne. They're borne more heavily on kind of the lower end of the socioeconomic ladder, where people are more prone to be unemployed, or have less savings and wealth to tap into. So the political cycles are driven by the politicians. Now, of course, most of these economies, the citizens ultimately vote for that, but it's hard to tie the hands of the politicians on fiscal prudence closely. And there are institutions that try to do this, like debt limits or constitutional amendments or things like that, but those are imperfect. So there's still this game that gets played where the politicians are present biased, are less patient relative to what the citizens would prefer, and they're the ones who are able to tap into these markets, and ultimately the citizens bear the cost of that. And that's kind of one of the themes I've explored is, would it be better off, the typical citizen, if the politicians didn't have access to these global savings markets? And it's not hard to come up with examples of small differences in patience or time discounting in which the country, meaning the citizenry, is better off without the access to the debt markets.
Wow.
Because of this political cycle.
So what about all these, all the years of low interest rates, cheap money, where countries, and especially low income and developing countries, were being told that they should take this opportunity to borrow money? Was that bad advice, in your opinion?
I think for many economies, emerging markets, it is bad advice. The rates are lower, but they still pay a premium. And we saw what can turn around very quickly in Europe. Greece and Italy, Spain, Portugal, Ireland were all able to tap into markets at very low interest rates, basically the same interest rates as Germany. And then, they built up large debt stocks. And then this can change very quickly. right? We saw the cost of debt in these economies spike in 2010, 2011, 2012, depending on the country. And then it was very difficult for them to service this debt, that had been at 1% interest or even lower. Now it was much higher, 4, 5, 6 times of what they had been paying or what Germany was paying. And then it becomes a big issue. And Greece did default, and the other economies had severe recessions. And that's with the European Central Bank and the Euro region, and along with the IMF, providing large assistance packages. Many emerging markets don't have the luxury of that. The U.S. Isn't necessarily willing to bail them out, or the IMF might not be willing to bail them out without big reforms, and it's very disruptive. So I do think even though rates might be low at a particular point in time, there is this vulnerability when you get your debt levels very high relative to GDP, that if interest rates spike, you can no longer finance the debt, roll it over, and pay the interest payment.
So, finally, what do you think is the answer? Countries, if they don't have access to these sovereign debt markets to avoid some of the problems that you've just described, what is the alternative? When countries face problems in their economy that have an impact on financial stability, what do you think is the answer there?
Yeah, so we do have some examples of countries. As I said, many of the the growth economies in Asia, but there are other economies, even in Latin America. Chile is an example where they've been able to smooth things through reserves. And kind of the recipe is a very stable macroeconomic environment, so low inflation, and relying on domestic savings for a lot of investment. And the government basically holds a stock of reserves for in response to crises. And with that kind of environment, then you can tap into global savings markets through private investment and private projects in these economies, and not involving government debt. We see in the data that government debt tends to crowd out private inflows of capital into these economies. Right. So reducing the government overhang of debt appears to provide a safer environment for private investment. And so you can still have this global pool of savings speeding growth, but it's not through government bonds, it's through private investment. And basically government debt needs to just get out of the way of this kind of thing by keeping it low and building reserves, not running large deficits, which need to be financed through inflation, and not having volatility in the amount of government spending.
All very interesting. Mark Aguiar is a professor of economics and the director of the International Economics section at Princeton University. Thank you so much.
Thank you for having me.
Look for Mark Aguiar's article, The Poisoned Chalice of Debt, in the June issue of Finance and Development magazine. Go to imf.org/FND. And look for more IMF podcasts wherever you listen. You can also follow us on X, what used to be Twitter, @IMF_podcast. I'm Bruce Edwards. Thanks for listening.